The trade desk is down 73% from all-time high. Is down today another 5%. But just looking at the graph, it's pretty violent here. You're dealing with a lot of changes in the valuation. I mean, look at this 60% drop, 200% rally or so, yeah, more than 200%, and then a huge falling knife here for 65% during like 4 months, and then another recent more than 50% drop in the last couple of months. But yeah, this is moving very violently, and that's what you get with sometimes with high valuation stocks, high growth, high valuation. You're just gonna have to face these swings. We own this stock. I have bought it around here in September, I think. Yeah, around 40 or something like that, and we are down 17% since then. Let's see here. This is my eToro portfolio. So we first bought it in September at around 47, and I added to it at around 43. So I initially started with 1.5% and added 2%. This is 2% of my total portfolio. So that's quite a big position for something that's moving so much. It will definitely add quite a bit more volatility to my portfolio if I increase it. Right now is sitting around 3.5%. Not down huge, just 17 is completely acceptable. I'm not trying to catch every bottom, but yeah, when I see huge moves to the downside, like this moves August, September, late September, I bought it around here. So yeah, today we're gonna analyze it and we're gonna be talking about it. Why I bought it, first of all. So this has a market cap of $18 billion, a PE of 42, and a forward PE of just 19, which is less than half of what it has right now. So this is a huge increase in earnings. Sometimes in young companies, earnings are very volatile. So maybe you'll see here something like PE ratio of 150. That doesn't mean it just had 150 consistently, or it had a very high PE consistently. It can have sometimes some type of companies can have even negative or no earnings at all. So young companies usually have a lot more volatility in the earnings department as well. They're not so consistent. But we're going to take a look. So I wouldn't put a lot of weight into PE ratios and stuff like that. In young companies, it's a lot more important to get a feel for the direction of the company that it's going, and some other aspects such as stock-based compensation and dilution, and yeah, how the margins are improving over time. Because there's no point in having a lot of top-line revenue growth here, as you can see, double digit, like 20% or more consistently, which is very huge growth. But at the same time, having a lot of share diluting going on through stock-based compensation, and then the margins not becoming positive, the operating margins. So there's no point in increasing revenue every single year by a lot if you're just gonna keep remaining unprofitable, and that's just gonna be dead money as an investment. I mean, you don't wanna. It's like DocuSign, you know, out of my the top of my head. DocuSign, one of Cathie Wood's stocks, had a lot of growth, as you can see here, huge growth, high growth, and yeah, even today I think they're not profitable, or yeah, they became profitable last year actually. Or this is not a great example. But yeah, let's just take a look real quick at the share price. Yeah, was very loved by the market because it was growing a lot, completely crashed and hasn't recovered. So there are a lot of things to take into consideration when you're buying a young company on the market. Teladoc, look at this. Price was trading at 300. Now it's sitting at around 7. What happened? I mean, look at this. 77 million 10 years ago, growing super fast. $1 billion just after 5 years. I mean, this company was growing very rapidly, growing by a lot, and then it stopped. So, and all of these years, they have never become profitable. So you have to be very careful where you put your money when it comes to young companies on the market. It can ruin, you can lose all the money, of course, or you can have these kind of situations where your money is just dead money sitting there. I mean, this company's never gonna recover. You know, look at this. It had a lot of growth, so the price went up a lot because of the growth, and then it completely crashed. And it's just gonna stay there because it's unprofitable. It's just gonna dilute you constantly just to pay the employees or something. I don't know. But yeah, let's take a look at the trades desk. Revenue going up over time by a high percentage, at a high rate, almost an exponential rate. So as you can see here, it almost curves to the upside. So that kind of tells you that the growth was not only very consistent, but um, yeah, it was high over a long period of time, and it just compounded. So as you can see here, 155 going down, of course, to 78, but then 52, 54, as you can see here, going from 52 up to 55. So this is 2017, 2018, when the stock market actually kind of went down in 2018. It had like a, it was a, it didn't, the S&P didn't end the year down a lot, but there was a bear market, especially in the NASDAQ 100 of, I think, more than 30% dip or something like that. So keep that in mind. 38% 2019, 26% 2020, and then accelerating quite a bit, going from 26 to 43. You have to keep in mind all of these numbers to get an idea of where the company is going. So when it comes to the top line, yeah, sure, it slowed down a lot since several years ago, since 6 or 7 years ago, but we're still at 20% trailing 12 months compared to 25% last year and 23% in 2023. Again, where is the price? I mean, it's been going sideways. When I see this, I consider it sideways, but obviously here you see down 60% over that. I mean, it doesn't really matter. For me, it's just zigzagging, okay? Starting in 2020, it just started to zigzag along, and we're back where we started in 2020. So basically more than 5 years of just going, the price action just going sideways. Can it go down more? Yeah, sure it can. But we are here to take a look at the numbers to see where we are standing right now today with the valuation and a lot of other stuff we need to take into account. Shares outstanding, look at this. So huge increase in 2016 to 2017, probably some type of acquisition because they weren't diluting that much. Well, they were actually. Yeah, 27% is still a lot of dilution, and then 9% on top of that. And then some type of merger and acquisition happened, and then still diluting, continuing to dilute here 3, 4%, 2%, 2%. But the most important thing now is that last couple of years, it's just 0.3, 0.2, nothing, and now we're in the green. They're actually starting to buy back some shares. So we're going to take a look at quarterly. And as you can see here, in the last quarter, the shares changed by almost 2% in the negative. So that means the number is green. Why? Because it's good for you. It's there are less shares outstanding on the market being traded, and so that makes your shares more valuable. So that's good for you. And even on the graph here, if we take a look at the last 5 years, you don't see it so well. But it's starting to dip, okay? Starting to dip, which is great. Exactly what we want to see. We don't want to see consistent high percentage dilution year after year after year, okay? This is already a profitable company, as you can see here in the operating margin. And it has been for, I mean, the past 10 years. 10 years ago, it was actually higher than it is right now. So it was trending down and down and down. Probably a lot to do with the fact that it was growing, and they were growing their operations, investing, yada yada. Companies need to do a lot of stuff, but we just want to get a feel for the direction it's going in. But now, since 2022, it started to go back up again. I want to take a look by quarterly, just to have even a better sense of where the margins are going. So as you can see here, a bunch of cyclicality year on year, quarter over quarter. So some quarters here, March, they are very thin when it comes to margins, March. And then the biggest, most profitable quarter of the year seems to be December for them. September, December, yeah, around 30%. So yeah, as you can see, it's going up. March 2023, it used to be negative. 2024, we're at almost 6%, and this year 9%. So everything going up and up and up. Exactly the direction you want your investment to be going when the stock price is in the toilet, of course, down 73%. So green flags here. Operating margins slightly dipping. This is not ideal. Hopefully they can recover. We see a low here of 70%. We are at 78% right now. Hopefully they can go over 80%. But the most important thing is operating margin, not gross margins. Gross margin is more like, yeah, you don't want competition to come up and put pressure on any of these margins. Same with profit margin, seems to be going up, trending up since 2022, which is great to see. So when it comes to operating margins, a couple of green flags. So first of all, 10 years ago, they were very highly profitable anyway, even though the company was quite young. So that's a green flag. And we're on an uptrend right now for operating margins. This is also a green flag when we're trying to buy a company that's been going down a lot. Cash and cash equivalents. We want our company to have quite a bit of cash on hand to deal with all sorts of problems. Maybe do a little bit of buybacks. Maybe acquire new companies to expand their moat, to expand their profitability and revenue, just to expand their operations. And a good management team that can produce very high margins in general for any type of company, you can trust them a lot more to make good acquisitions, and not only make the good acquisitions, but take the companies that they acquired and make them more profitable and integrate them into their own main company. And yeah, there are a lot of aspects when it comes to young companies and having a lot of cash on hand. So this company has a market cap of 18 billion, and right now we have around 650 million in excess cash, which is okay, not anything exciting. Last year in December we had 1.3 billion. Now this was a lot more exciting, but obviously the market cap wasn't so low. It was much higher, probably more than 30. We're gonna check the history for market cap as well. But let's take a look at debt. Total assets going up over time very nicely. 6 billion trailing 12 months, around 6 billion. Maybe we end up the year with more than 6 billion. We're gonna keep an eye on this company. Shareholders equity also going up over time. So yes, assets go up by a lot, also liabilities, but liabilities not so much. And so our equity in the firm increases, where we are at around 3 billion right now. So this is trailing 12 months, 2.6. By the end of the year, you will probably see this going over 3 billion. I'm going to be curious to see. Net cash, we are net cash positive, and we have been consistently over the last 10 years. Great to see this. This is a software as a service company. Actually, it's in the advertising agencies industry, sector of communication services. So not really software as a service, but it acts like one when you take a look at the margins. But yeah, anyway, great to see more than 1 billion in net cash. So what's that? More than 5% of the company's market cap, like 6-7%. That's great. Another green flag. So green flag when it comes to net cash, shareholders equity going up over time nicely. Green flags on the balance sheet. Net income going up over time nicely. As we talked about, the December for this company is the biggest one to watch out for. It seems like last year, December 2024, we did 182 million in net income. Curious to see the next earnings report, what we're going to do here. But yeah, not extremely smooth, but obviously it goes up over time by a lot. Now, the next thing we don't want to see is excessive stock-based compensation, which unfortunately here we do have a bit of a plague, a bit of a problem. We have a huge stock-based compensation, but when compared to, I mean, this $500 million compared to the net income, of course, I mean, it's more than the net income, but at least it's flattening out. It's flatlining over the past 4 years. They chilled out. They're not awarding to the management and the employees. I mean, $18 billion and this type of company awarding more than $500 million in stock, it's excessive. It's not needed. Hopefully this goes back down a little bit, and hopefully the net income will exceed this stock-based compensation very soon. And with the type of consistent growth that this had, let's say if the top line revenue keeps on growing double digit in the next few years, around, let's say next year 18%, and then 16, 15, 14, 13, something like that, and combined with the fact that the margins are going to be improving, then the net income that we see here is definitely going to be much higher than the stock-based compensation, but it's still a huge percentage, and we would like this to be quite a bit lower. This is a red flag. So we had several green flags so far, but we need to note this as a red flag so far. Yeah. And then Let's take a look at repurchases of common stock. They have started to do some share buybacks. So they did 700 million in 2023, and then followed up by 370 million. So let's just say 1.1 billion in these 2 years. And now 1.1 billion trailing 12 months, could be a lot higher at the end of the year. Let's just say $2.5 billion of share repurchases in the last 3 years, which is not bad at all. A lot more repurchases than the issuance. So obviously they bought back 1.1 billion compared to the 500 million of stock-based compensation and the issuance that they had of 161. It exceeds that. So they do return equity to the shareholder, and we are in the green as well as a shareholder. It's not like they're just going to dilute us, and you have seen in the percentages in the income statement as well, the share count is starting to be reduced by actually 2%, which is very nice to see, 1.9%. Let's go back to the cash flow a little bit, look by quarter. So yeah, looks like they are doing it sporadically, not consistent at all, but this is quite a start. So over the last 2 years, they have been buying back shares. So this is a company that says, okay, we're going to repay our shareholders here. So another green flag, combined with the fact that we do have quite a bit of money on our hands here, 650 million. This is a nice combo. Nice combo to have as a two green flags that you can put together. When looking at this price action minus 73%, you can say, okay, I'm a little bit protected here. They can jump in and buy back at these very low levels, and I'm not going to have my risk to the downside is not going to be so big. We are here at the ratios. Let's take a look at the valuation ratios. Market cap, just quickly going to take a look at market cap to see where we are standing. So at all-time high, this used to be trading at 58 billion total market cap. Right now we are sitting at around 18 billion, and we were at this level back in before 2020. So valuation came down a lot just by looking at the market cap. Okay, PE ratio 2017. I mean, look at this. This was trading around 50, 70 times price to earnings, 98, 100, even going back in the mania, during the mania of 2020, more than 100, 150, 170, 150. So it was trading very, very highly, and it was extremely expensive. Now it's been coming down and down and down. It's been coming down a lot. I mean, look at this. Look at it. The valuation went kind of nuts. Maybe they also had a period where the earnings weren't so nice, and you see this mountain forming here. But 42 compared to 156 from 2018, not that bad. But forward PE much lower. 18, 19. This is much lower than 32 than it used to be at in 2017. So expect much lower valuation in the future because earnings are going to increase. And if they can be consistent at growing and maintaining high margins, higher margins, and going higher and higher, then this 18 will quickly turn into 12, 11, and even single-digit numbers. EV to sales 6 times, not too bad. EV to EBITDA 28. For the 28 is not that bad. For this type of company that has huge top-line growth, is not bad at all. It is high, not excessive, not very high, but I wouldn't give it a green flag or a red flag either. Return on capital invested, the same as the margins here, used to be over 30, dipped quite hard until 2022, and now we are on a recovery path. So nice to see that we're recovering. This is exactly what we want to see. Return on capital employed, same kind of story, going up since 2 years ago. I would put these two both as a green flag. Why? Because first of all, they were at a very high number in the future 10 years ago, and now they are on a recovery path. So this is another green flag, not a massive, not dark green flag, but like slightly green flag. FCF yield, valuations in terms of free cash flow yield, 3.75%. Not super exciting, but not that bad either. Compared to the S&P 500, which is less than 3%. Yeah, you're not getting a super exciting bargain, but if the price remains the same at 37 that it is right now, and 2 years go by, this 3.7% easily can turn into 6-7% even. Why? Well, the top line is growing and growing consistently and very fast. So if the top line remains consistent and grows like this, and also the margins, the operating margins goes a little bit higher, this 3%, 3.7% is easily going to be much higher than this. So yes, it doesn't look like a super bargain right now, but it doesn't need to be looking like a super bargain. You can buy it right now. I mean, it's already 75% off almost. So I start to look at, I buy low and I sell high. I start to look at companies that go down by more than 50%, and anything that exceeds 70%, it's already, it's very difficult for a stock to remain down 70%. If it is a high quality and everything is in place, if it doesn't have any huge red flags. We had only one red flag with this, which is stock-based compensation, and hopefully that's gonna solve itself through over time, either by the stock-based compensation not increasing, remaining at the same level, and also the net income we want to see here, net income higher and higher and higher. So that was about it for the trade desk. We own it. We plan on adding a little bit more when I take profit from my Adobe. Adobe just got started today after earnings. It's up 30%. So maybe in the next 3 months, I might have the opportunity to add some more. Hopefully the price goes down a little bit more. And the next video I'm going to make is going to be about Paycom software. Kind of the same story. High margins, high growth, down 70% or more. This is a very old company in my portfolio. It used to be number one position in my portfolio since last year, but as you can see here, 2024, I bought it. I did take a lot of profit from these positions, and now it's come back down again to the price levels I was at 1 year ago. So I'm going to be looking to add to this as well, and I'm going to be making a video right now. After this one, you're going to be seeing a video about Paycom software.